So there are multiple ways to get wealthy as a business owner. There's no hard and fast way to go about it. Ultimately, all of the pathways are going to be difficult. However, there are ways for you to make it substantially easier on yourself over the long term if you understand these simple rules of wealth creation. Now, when it comes to building wealth as a business owner, there are basically three ways that we create wealth. These are tried and tested ways that have worked for hundreds of years and that have long track history of performance and long-standing methods that have been used to create those particular outcomes. The first way is building wealth through business. The second way is building wealth through property. And the third way is building wealth through the share market. Now let's unpack these a little bit more. So the first way in terms of building wealth through your business is basically building wealth through private enterprise, that you have a stake in the outcome, that you have a majority stake of that business, meaning that you can control that business, and it means that you can use your skill sets, you can use your efforts, you can use your capital in order to improve the quality of the outcome of that business. So typically for most of us as business owners, is that firstly is created through building value into our existing business. We have an established business, we want to maximize the profit, and we ultimately want to get it ready for sale. Because for most business owners, they don't want to sell their business until one day they do, right? And usually that business isn't ready for sale. So it's because they think that because they've poured blood, sweat and tears, and because they've been in business for 10, 15, 20 years, that business has value. It has value to them by way of emotional equity, but it doesn't necessarily have value in the eyes of an acquirer, somebody who is going to buy that business and essentially take it to the next level or be the beneficiary of the value that has been created by you as the owner. So there is a formula that needs to be followed, and fundamentally it comes down to maximizing the profit and disconnecting that profit from your effort and energy as an owner. Second, reducing key person risk in yourself, so building yourself out of certain departments, so out of the marketing department, out of the sales department, out of the delivery department, out of the operations department. Reducing the key person risk of your clients by diversifying your client base. Ideally, we should never have any more than 15% of our income from one particular source. And thirdly, diversifying your team risk. So once again, we don't have a lot of siloed risk in any particular one role, that we ideally have departments and we have systems and processes and job descriptions and templates that ensure that if somebody was to leave, that we have a process that we can replace them predictably and achieve the same result. So that's the first element of building wealth through business. The second element is building wealth through acquisitions of other businesses. I typically look to acquire other aligned businesses that either serve the same customers and clients or actually do the same thing, and essentially allowing us to acquire that business, giving us economy of scale, and also providing us what we call an arbitrage opportunity. Because if you build a big enough business, your valuation multiple of your business will go up. And you can acquire smaller businesses at a lower valuation multiple, meaning that you acquire it, say, 3 times profit. Your business might be valued at 6 times profit, meaning that when you buy that business and roll it into yours, it is automatically double the price. And this is a commonly known arbitrage strategy that many successful business acquirers use. Now, business acquisitions is complicated. There's a lot of moving parts to it. It is very hands-on. It is an active income source because you do need to be actively involved. But if you're passionate about that, if you've got a skill set, if you've got an established business that has a really great value proposition, and you can strategically acquire other businesses and then build those businesses so they're always ready for sale, it's a tremendous way to build wealth. And it's actually my preferred way to build wealth myself, because I tick all of those prerequisites. I have the skill set, I've got the existing business, I've got the strategy, and I've successfully implemented it, and I've got a track record, but I'm deeply passionate about it. So of course I'm going to be more successful at that than somebody else. Next is property, okay? For many business owners, either their business doesn't have value, they're running it as a lifestyle business, they're using it to create cash flow. Then if their business doesn't have value, or they don't want to bank on the value of having to sell their business to be financially free, then the next best thing is for us to take profits out of that business and to build wealth through property. And the reason for that is because we can exponentially increase our cash on cash return because we can go and have a certain amount of deposit, let's say 20%. We go and borrow 80% from the bank. We now control 100% of an asset, and compounding happens on that 100% of the asset. And when we consider the 20% that we put in, that magnifies our cash on cash return. Let me give you an example. We can actually leverage up to 90% in many cases. So let's say, for example, we had a $100,000 deposit. We go and buy $1 million property, and that $1 million property goes up by 5%. That is now a 50% cash on cash return because you put in 100, the property's gone up 50,000, so that's a 50% return on your money, right? Because of this magnification, it allows many property investors to snowball their wealth very, very quickly. The important part though is you must have a strategy. Not all property goes up, not all property is good, and all property is made the same. We need to be able to confidently and predictably understand the economic drivers that give us the ability to maximize the probability that we're going to achieve a return on our property investment. And this comes down to a number of factors. It comes down to net migration. There needs to be more people moving to a place than are moving away. 2, there needs to be diverse employment. That ensures that we're not relying on any particular one sector for it to go up in order for the market to go up. And of course, if that employment sector collapses, then the property market's going to collapse if it's reliant on that one sector. So we want diversified employment. 3, we want to see infrastructure spending, both public and private. We want the government spending on roads and hospitals and schools and all of these kinds of amenities that make a place more livable. And we also want private spending, things like restaurants and entertainment, all of these things that keep people in a location because it increases the desirability of that location, right? 4thly, we want to make sure that there is a fixed future supply or a limited future supply. So as a general rule of thumb, we don't buy in inner cities because they can build towers as high as the eye can see. And we don't want to build on fringes where there's what we call greenfield land, where developers can continue to build house and land packages across the horizon, right? And they flood the market with stock. We want to buy in infill areas whereby they're already built out, already landlocked. So in order for somebody to build something, they've got to buy something and knock it down. And that is a complicated process, and there's typically restrictions in place around the number of dwellings that can be built. So we have control over future supply because property fundamentally is about supply and demand. If there is more demand than there is supply, markets will go up. And if the opposite is true, then markets will typically go down or at very bare minimum sit flat. But there is a one last factor, which is affordability. Now, this is not what we can afford as investors. This is what the local population can afford. And we need to look at what is the percentage of average household income that is going to the minimum mortgage repayment, and similarly to the minimum rent repayment, right? To the average rent in that particular area. Because property markets will go up assuming the supply and demand dynamics are in the right play, but it is capped out by affordability of that population, right? The property prices can only continue to go up if people can afford them to go up. So if we can understand those 5 drivers, then we can have a pretty good idea around what the property market is going to do in the future. Now, this is where we need to have a certain level of education, right? Once again, we've got to have the skill set, we've got to have the strategy, we've also got to have the passion. I'm passionate about property, less so than business. So my satellite strategy is to invest in property. I am underweight in property right now. My focus is acquiring businesses. Once I've got a few more business acquisitions under my belt, I'm going to pivot back to property in order to make sure that I can reweight my portfolio. Now, the third part is the share market. Now, the share market is a fractional investment in a publicly listed company, somebody else's business, a big business. And the idea of why we do this is because there are phenomenal businesses out there that are at a phenomenal level of scale and produce amazing profitability and manufacture a lot of value in the world. And if we can have a fraction of their business, then we have the opportunity to be rewarded for the upside of that business. And that comes by way of profit distributions, by way of dividends, and also the capital appreciation by the value of the business going up, therefore meaning the value of your shares go up over time. Now, the thing about the share market is because there are thousands of companies listed over all of the various stock markets around the world, and this is where it becomes really overwhelming. So many business owners, when they're trying to think about getting to the stock market, what companies do I pick? For many of them, it's throwing darts at a dartboard. And there's a couple of ways you do it. You either understand the fundamentals, where you basically look at the financial statements of a particular company and you look at, based on the intrinsic value of that company, its individual strength and its kind of trajectory that it is on, then you make a judgment call on how you believe that's going to perform into the future. You could do technical analysis, that you could look at charts and momentum and what the psychology of other traders are doing, and utilize that in order to kind of make money in the market, whether it's going up, down, or sideways. Most traders who trade technical trade the market agnostic, up, down, sideways. They basically are just trading momentum. The third way, which is my preferred way, is passive, right? I don't really have any interest in researching publicly listed companies. I have no interest in looking at charts and all of that kind of boring crap. I would prefer to bet on entire markets under the belief that essentially those markets are going to do better over the long term than my money sitting in cash. For example, am I confident that the US market, the S&P 500, is going to be higher in 10, 15, 20 years time than it is today? Yeah, I'm pretty confident of that. Same thing with the ASX 200. I feel exactly the same about it. So I can make a judgment call that I can bet and use an index fund that allows me to get exposure to every single company in that market and essentially get the upside. And some of those companies, let's say out of the ASX 200, some of them are going to shoot the lights out, some are going to shit the bed, and some are going to do average. Because of the sheer mechanism of that index fund, I get the average of all of them. So because I'm not passionate about it, I choose to take a passive approach that allows me to get the average of whatever the market does. I don't try and speculate in something that I'm not passionate about, that I'm not necessarily super specialized in, and I don't necessarily want to learn the skill set, right? So this is the key, guys. As a business owner, there's 3 ways to build wealth. I believe that you should focus on all 3, but you need to understand which of those things you're going to be active in and which of those things you're going to be passive in. And as a result, you can build a great investment strategy that can manufacture a tremendous amount of wealth. So if you've got any questions, let me know in the comments. Hope this has been valuable. I'll catch you soon.